Credit is a tool. Most people are going to need credit numerous times across their lifetime. Maybe it's to borrow for a higher education degree, and that's going to improve your earning power and reduce your chances of unemployment. That's one of the so-called good debts. Not that we want to be in student debt, and some people, frankly, take on too much student debt. Like if you take on six figures in student debt and you don't really have the career path and the earning potential to pay that off, that can be problematic. So it's still important to be thoughtful, shop around, consider the bang for your buck. But in general, student debt is a better debt. Credit card debt is usually a worse debt. That's a consumer debt. It's for stuff that you've already bought. It's the vacation you already went on. It's the outfit that you already wore. It's the restaurant meal you already consumed. And yet you could be paying that off for years at a 20 or 30% interest rate. I know you do what you have to do. Sometimes we're financing entirely legitimate things like groceries and the gas we need to get to work and things like that. It's not always easy, but we do talk about good debt and bad debt. A home is a place to live. It hopefully appreciates in value, but more than an investment, it's a place to live and its roots in the community. That can be seen as a better debt. Some people are taking on too much auto loan debt and they're really
That's a
upside
big
down.
one. I've seen a lot, especially on social media. You see these people, these crazy cars and these crazy loans, and it's wild what some of these car loans are.
Yes, even if transportation is a necessity, taking out a $50,000 car loan and stretching it out over 7 years and paying a 8 or 9 or 10% interest rate, that's what becomes really problematic. So that's where we do really want to talk about things like, well, of course, putting your best foot forward from a credit scoring standpoint, but also thinking, can you drive your existing car an additional year or two? Can you buy a cheaper used vehicle? Can you sort of cut corners? Could you get by with public transportation? These are some of the questions to ask yourself because we see way too many people upside down on really big car loans. And a sizable percentage are paying $1,000 a month for a car, and they're stretching the loans out longer and longer, which is leading to higher interest bills. And that's one to be careful about.
When taking out any sort of debt, it's really easy to fall into, even if it seems like, okay, this is a good debt, it's very easy to like sort of fall off the rails a little bit, and your loan has now turned into more of a bad debt situation. I know for something to be considered a good debt or a better debt, you need to like look at the return that you're going to get on it, I guess the chance that you are going to get that return on it versus the borrowing cost. How can people sort of balance these things so that they can try to make sure that any loans they're taking out are sort of falling more into this good debt category so that they can help build their credit and use it as a tool and not have it be detrimental?
Traditionally, we've thought of something like 7 or 8% as kind of the cutoff between lower cost debt and higher cost. But nowadays, 7 is about average for a lot of products like car loans and student loans. And it's not like a few years ago when you could get a 3% auto loan or a
Mm-hmm.
3% mortgage rate. I mean, rates have gone up across the board as part of the Fed's inflation fight. So it's harder to find a truly low cost loan these days. You do want to think about that overall budget. You want to think about your overall financial life. Some people say that rent is throwing your money away. I don't subscribe to that theory because buying before you're ready can be a problem. If you don't have enough of a down payment, if you don't have a cushion for repairs and maintenance and property taxes and insurance, rent gives you more freedom when it comes to the ability to move, maybe for a job opportunity. You want to have the long view in mind. Or we were talking about cars. I mean, maybe you need a car, but you don't necessarily need a brand new car with all the bells and whistles and the really high price tag and the higher interest rate. So it's definitely important for people to have the long view in mind. And that comes to building credit as well. It's something parents can help their teenagers do, maybe adding them as authorized users on their credit card. That can help you build credit, or getting that student card when you're young, or wherever you are on the spectrum. Even if you're older, there are definitely ways to build and rebuild. Don't be afraid to ask for help with any of these things. Credit building, getting out of debt. There are some great nonprofit credit counseling agencies like Money Management International and Green Path, and they can really help. They can transform your 25% credit card rate into a debt management plan with a 6% rate
For
over 4 or
sure,
5
yeah.
years. And things like that can be really beneficial.